Well, good afternoon, everyone, and welcome to TradeStation's very special event today as we put the spotlight on Mr. Scott Redler of T3 Live. Scott Redler is the Chief Strategic Officer of T3 Live, and their company was founded to help investors like us generate income and build wealth. Their approach includes a mix of trading, training, and technology to help traders succeed in all market conditions. Mr. Redler began his trading career back in 1999, and he began serving as T3 Live's Chief Strategic Officer in 2007. As the financial crisis began, Scott's accurate calls of the market made him a regular guest on CNBC. Today, Scott remains a professional trader and is regularly featured by CNBC, Bloomberg Television, and Fox Business. His technical analysis work has also been cited by the Wall Street Journal, Reuters, MarketWatch, and Investors Business Daily. I'm Don Prattle, the Director of Trader Development and Education here at TradeStation, and I want to welcome you to this presentation as Scott Redler shows us his two favorite trading strategies, the Red Dog Reversal and the H-Cell Setup. Now, a number of you have already posted questions in the chat panel regarding the recording, so let me tell you how that works. There's a link in the chat panel that will take you to the video archives for TradeStation in YouTube. If you failing the link, if you don't use the link today or tomorrow, you can actually just go to www.youtube.com/TradeStation and review any of the TradeStation video archives. This presentation will be available there tomorrow. Now, if you are a TradeStation customer, you'll be able to access this presentation in Video Station. Now, the presentation will take as long as it takes to answer all the questions. Scott is willing to stick with us as long as you're satisfied. So remember that our presentation is for educational purposes only. So any of the symbols and any of the trading ideas that we discuss are for demonstration purposes. They're not recommendations. Our presentation is not an offer or a solicitation of any kind in any jurisdiction where a TradeStation affiliate is not authorized to do business, including but not limited to Hong Kong and Japan. Active trading is not suitable for everyone, and options trading carries a high degree of risk and may not be suitable for all traders. I've also posted in the chat panel, if you want to scroll back towards the top, the several pieces of disclaimer information and disclosure documents regarding the characteristics and the risks of not just options, but all of the asset classes here at TradeStation. Now that we have that out of the way, I want to turn things over to Mr. Scott Redler for his very first presentation here at TradeStation in quite a long time. So, Scott, thank you very much for spending time with our traders today, and we want to welcome you to TradeStation.
Well, Don, thank you so much for having me, and I'm so happy to be here with TradeStation and all of your subscribers / traders. You did a very good job explaining about my history and about who I am as an individual and kind of where I came from. I don't want to get into all of it again just because we only have a certain amount of time, and I want to provide as much value as possible. I think just the important thing to take away from my little bio here is that I have been trading since 1999. Okay, believe it or not, yes, you could have made a living from 1999 until 2017, and we've definitely survived many different types of trading environments. We witnessed the tech bubble bursting in 2000, the bull market that started in 2003 when we invaded Iraq, the financial crisis, like you said, in 2007-8, which we were able to trade through because of seeing the tech bubble burst and witnessing the way that traded, so that helped us during that financial crisis. And then, once we hit bottom, we again had a really nice trending market with definitely, some pockets of awesome trading and some pockets of hands-off type action from 2012 all the way to now, where I think we've heard every different top caller come out in the market saying we're going to crash, we're going to correct 10%, we're going to correct 20%. So, from my experience, the best thing I've done since I've been chief strategic officer, I've tried to turn off the noise. I've tried to develop a process to approach the market on an active daily basis to make net P&L, because just like you, I do trade for a living. Although I am a partner of this firm and I do have a vested interest, I'm in the trenches, and the majority of what I do comes from trading. So what I'm going to try and do is help you with a few different strategies that I've learned and how I've evolved through the years, because we've watched things go from fractions to decimal points. We've watched markets go from high volatility to a low VIX like we've seen, and we've had to figure out how to make money and interact with it in a way where we can keep our sanity. And the way you see the bottom here, I've completed 50 plus triathlons, including 2 Ironmans. That's not to brag, that's to show you that, you know, in order to keep my sanity and keep my balance, is I blow off steam by training, by going to the gym at lunchtime and wiping off the day and starting fresh for the afternoon. And I'm a big advocate that everyone has to have balance in their life as traders. Otherwise, it's so easy to burn out, and it's so easy to turn a good day into a bad day, or a great day into a fair day, and a day that nothing goes on into a day where you push keys and all of a sudden lose more than you have to. So what I want to get into is I want to tell you a little bit about what we're going to get into, okay, and what we're going to cover. What I want to do is I want to go over very quickly the moving averages in my trading approaches, because each market, you could segment into months, quarters, sometimes years on the types of composure we have. And the way I figure it out is I try and just really be simple. I simplify it. I try and simplify it. That's why I've been in the media for 10 years, because I basically talk to people as if, they're not Yale or Harvard graduates. I talk to them as if, I'm talking to myself, where I need a simple approach in order to be able to handle my process. And I've tried to simplify it as much by using moving averages and obviously chart patterns and trends and a lot of other things. But for today, I'm going to talk to you about my moving average rules, which you've seen me say on Twitter, as well as I'm going to go over my my number one trading technique, which is the red dog reversal. If we were in a bar and we had a few hours, I would tell you the real reason on how that name came about, but we can't get into that today. And then the H cell setup is also a great technique to use in a tactical environment. And then at the end of it, I just want to give you a quick little anatomy of Roku. I know a lot of active traders have been watching it. There's been lots of opportunities over the last week, and show you how with a few different sets of rules and these actual setups, you could have made some really good active cash flow money and with very limited risk. So what we're going to do is we're going to get into the next slide, which is really just going over quickly the moving averages and my trading approaches, because so many people have opinions in the market, and this is a really good way to get away from having opinions. The bottom line is I do use exponential moving averages, but some people use a blend, which is fine. You blend the 2 different types of moving averages because it's more of a zone, and with all computers out there, they try and steal your lunch and and try and break it below a moving average, break it back, which I'll get into. But really, the 8 and 21 day is where I like to live. Why do I like to live there? I'm an active trader. My job is really finding tight patterns that resolve to the upside or to the downside, where we can make 2 to 5% over a 1 to 3 day time period, and to ride trends. And as long as we are above the 8 and 21 day moving average, we are in a strong trend. What I try and do in a strong trend, I try and be in a portfolio approach, which I'll get into. If everyone that calls for these corrective periods, in order to correct, in order to go down 3% off highs or 5% off highs or 10% off highs, what do you have to do first? You have to break the 8 and 21 day moving average and then stay below it. Okay, and if you get out of positions or you reduce risk, you then could test the 50-day moving average, which is usually below. So instead of getting caught and losing money, you get out of the way, and then you could test the 50-day moving average for potentially a swing trade or just a tactical trade that can create cash flow. And in order to get to the 200-day, you have to get and stay below the 50-day, and that's where you judge the long-term trend, which is the 200-day moving average. So, I know a lot of in the news people talking about GE. How could this have happened? Well, if you look at the chart of GE and look when it broke the 200-day and when it broke the 8 and 21 day and broke the 50-day, I don't care if it's GE. You follow my moving average rules, and you will not get caught in a situation where you blow up your account. Same thing goes with oil. Remember when oil broke 80? When it broke 70, it was below the 200-day and went all the way down to 25. So again, no opinions. What you do is use tactics and use moving averages to help you gear in what type of market, what type of complexion you have, in order to then base some of your trading decisions off of that. So in this presentation, we're going to get into candlesticks, but again, one of my rules, which I think you take a snapshot, which will always keep you safe, is when you're above the 8 and 21 day, I try and be in a portfolio approach. If you're on my VTF, you usually see me in 4 to 12 of the strongest stocks out there showing relative strength. And when we break below, okay, the 8 and 21 day, that's when I say I'm going into tactical approach, which means I usually only have 2 or 3 positions, some long, some short, and that's when I start using the red dog reversal and the H setup for tactical cash flow. Meaning you're below the 8 and 21 day, you could use the red dog reversal to test the 50 day or the 100 day or the 200 day, but you're doing it with a plan and not trying to catch a falling knife. I'm sure a lot of you guys out there have said, hey, this can't go down anymore. Yes, it can. So if you learn how to use the red dog reversal, you'll be able to buy into just say some type of pullback or even some type of crazy oversold environment with the plan. Same way, instead of looking for a top, you could find it by using the red dog reversal and then use the H sell setup in order to manage a trade to the downside. So before we get into the actual setup, I just want to show you the type of charts we're going to use, which we're going to use candlestick type charts, which I'm sure you're all used to. This is from TradeStation 9.5. And what you'll see is the different moving averages. And I just want you to take note that the 8-day is in magenta. Isn't that a pretty color? Magenta. I think purple is my son's favorite color. The 21-day is red, and the 50-day is blue. So, again, all these moving averages are exponential, and you have the 8-day, the 21-day, and the 50-day. So I want you to also take note of where these moving averages are when I go over the strategy, so you know what type of trend we are in, just to base some of your thought process on. So now what we're going to do is we're going to get into the red dog reversal. Think to yourself, have you ever seen me talk about this? I'll be honest, the red dog reversal has taken lots of different forms, okay, because of the type of trading we have in the age of computers. What it's really done is it's become a way to judge whether a trend could reclaim prior lows and become an action area trade, or ways to really spot major reversals in different sectors. So the definition on paper is it helps us catch counter trend moves in an overbought or oversold stocks or sectors. It could be used for anything. It could be used for a day trade, and it could be used for a swing trade, and I'll tell you how you could expand on that. And again, you could use it in stocks and ETFs. It gives you concrete parameters. It's very important. You could either use it as a concrete system, or you could tweak it a little bit according to your own risk parameters, which I'll also get into a little bit later in this presentation. So what I want to also show you is a little bit of how it fits best. Okay, when it fits best is when when stocks are pushed in the same direction. Okay, for 2+ days, fear and greed builds, and people start looking for a way to catch the other side of the trade, which I'll get into, and I'll show you the psychology behind it. And then why a reversal in the trend catches traders off guard and turns an action area into a really fast trade. And that's why I love it, because it creates a fast trade and then sometimes gives you a bigger trade. So for the active trader, we like fast trades, and for the swing trader, we like calculated swing trades that you could then stay with. So as we get closer to the actual chart, I just want to keep giving you guys some of the parameters. So here is the red dog reversal buy parameter. Stock has a short-term pullback, often for 2+ days. Okay, trades below a prior day low. Okay, what the importance of that is, if you're going to be down for 3 days, for 4 days, for 5 days, in order to go from down 2 days to down 3 days, what you have to do is you have to trade below a prior low. You trade below the second day low, okay, then you could have a third day low. You trade below a third day low and stay below it, then you could have a fourth day low. So that's why we judge the low. Again, in order to have a fifth day low, what do you have to do? You have to get below and stay below the fourth day low. And basically, the importance of that is when it trades back above the prior day low. Okay, if you're going to only have 2 down days, it's going to get below the second day low, come back above it, and then there's no 3-day low. Then there's no 4-day low, there's no 5-day low. So if there were shorts looking for a 3rd down day or a 4th down day or a 5th down day, they have to say, uh-oh, there's only 2 down days, and now it's a reversal up. Okay, I'm going to show you, I just want to give you a little bit of the psychology of why that low becomes cinch a battleground spot, because once that trade is triggered, you then could buy when you get back above, just say the second day low. And then what you'll do is you will put a stop. Okay, this is chicken scratch here. Didn't work there. You'll put a stop below the third day low. So let me give you a little bit of a visual, okay, because we're all visual as traders. But basically, that prior day low is your action area, and then the day's low will be your stop. Okay, so that's what happens, and that's why you have your risk defined. And then usually what you want to do is you want to take a third home as a swing trader, because sometimes you caught some type of bottom tail, which you'll also see. So let's get into a stock that I trade very often. It's Google. Okay, Google was at 870 here. You look here, this is 870. Stock corrected for one day, for another day, for another day, and then here you go again. So literally it went from 870 to 829.10. Okay, so what I do is the next day is I say to myself, what do I know? Okay, so here is all you know. So what I would do is, this is the end of, just say, whatever this was, not sure what the date was, could be March 24th. All you know is the prior day low is 829.10. That's it. That's all you know as a trader. There are some people out there that said, hey, Google's going to 700, it's going to, 800, it's going to 750. In order to go to 800, it's got to get below and stay below 829.10. So if you're thinking it's getting below 800, okay, boom, that is a spot it's got to get below and stay below. If you said, hey, you know what, I got out of Google when it broke this trend here and broke the 821 day, you know what, I have the opportunity and the luxury to test it down here because you didn't get caught in that move. So that becomes an opportunity for you. So again, 829.10 is all you know. So the next day, if it breaks below it, comes back above it, you're a buyer here, and then you're putting a stop in at that day's low. So here's what happened the next day. Okay, what you had was a red dog reversal. So after a $40 pull-in, it went below and then reclaimed it. So you're buying it at 829.10. This is the low, 824.50. So your risk is $5. That's what it is. It's a $5 day trade. So this is a battle between the bears and the bulls. The bears who think it's going lower, they're shorting it, and all of a sudden it goes below, comes back above. Uh-oh, I got to cover this. It's down 4 days. It could bounce. Those who are looking for a buy that might have gotten out here, etc., they're saying, hey, I just missed $40 of a pull-in. I want to be a buyer here because look what happened on this day. It went below and stayed below. So anyway, that's your buy. That's the strategy. Clear cut, very simple, very mechanical. You can be very mechanical. So what some people will do is, I think this closed near 840. So you made for yourself about $11 on $5 risk, 2 to 1, not so bad. Then what people will do is say, hey, I'm going to take a third and I'm going to put a stop here just in case it bounces more than it just did this day. So it's a way to manage the trade also, because this was buy area number 1, and now perhaps you get buy area number 2. So the question is, how does that develop? Here's your next day. So right now, if you were in a swing trade and said, I'm not going to touch my third, whatever third means to you. Like if you just say you bought 1,000 shares here, okay, and then on the close you said I'm taking 300, okay. If you took 300 shares here, on there you said I'm taking 100. If you took 5,000 shares here, I talk in tier systems. I talk in tier systems because tier systems help everyone know what I'm talking about, because shares means something different to everyone. Anyone who's a subscriber to my service, I don't care how much you manage. You can manage 100 grand, 2 million, 100 million. I'm talking to you in tier size. So right here, you could have been just saying, you got your tier 1, whatever that is, or tier 2 even, went back to tier 1 and held a third. It held here, and then right here, when it cleared a 4-day range, this could have been your second buy. So now all of a sudden, you're still in from 829 with $5 worth of risk, and now you're adding above, this little spot here, because anyone who's still short says, oh my goodness, it's a new trend, I got to cover here. That's your buy. And then all of a sudden, you could have said, hey, you know what, I'm going to get back to what I had from here, and you just are still riding a trade from 829 to 850, and you had another cash flow spot right here as a second trade. So that's how you use a tier system, and that's how you do trade management. So all in all, this trade wound up going up to about 860 before you had to remanage it. But really, the red dog reversal took place right there after 4 down days, very calculated. So now I want to show you, another red dog reversal. So let's go to another example here. Okay, this is the XLE. Okay, this recently happened actually. This is when the XLE pulled back when it hit as high as like 69, which was the first resistance there. Pulled back from 69 all the way down to whatever this low was. So again, what's the question? This looked actually like a little red dog reversal, okay, where you could have made a little bit of money because what did it do? It went below this, came back above it. So, you could have made a day trade, but if you took home a third, you might have given back this day, which I'll show you why, which is why I only take a third. You want to net money. You never want to put all the money you made in one day at risk. So this was a small red dog reversal that didn't stick, and let me show you why. So the next day, again, what are you looking at here? 66.82. So from 69 to 66.82, that's a decent pullback. So this is all you know, 66.82. So that morning, I'd come in on my note, I would say, the XLE that hit a high of 69 is pulled back to with a low of 66.82. It did a minor red dog reversal. Let's see if it goes below and reclaims it and tries and give you a more compelling one. So the next day, this is what happened. Boom, traded below 66.82, hit a low of 66.34. Okay, so what do? Same scenario. This is what you do. You buy it here. Okay, and you might have even lost money on the third if you tried it there. Okay, it happens. And then, you had a really nice day trade, a lot more potent of a day trade. And then what do you do again? You keep a third because that's what you do. That's what the process is. If you play blackjack, you got to double down on an 11 versus 6, even though one time, you got a 5 and he had a 6 and got a 4 and got a 10 and you lost. Okay, probability to say that's what you do. So anyway, again, the strategy, if you're very mechanical, is just this. Okay, you buy here, that's your stop. Okay, and then all of a sudden on this one, came up a little bit, and now it reclaimed the 8-21 day. Remember we talked about when things are above the 8-21 day, they're a little bit better. So this is buy area number 1. You know what? You might not have even added to it. Maybe you did if you really, very active in the XLE, which I'm not, typically. But again, I was on CNBC talking about how it was a decent trade during this time period. So then now you go to see if, your trade management. Wow, look here. Not only did you have your red dog reversal, okay, it reclaimed the 8-21 day, so that could have been your ad. And then all of a sudden, from here at 66.82 with literally 50 cents of risk, you're now all the way back up to 69. And then I remember this, it went sideways and gave you an extra trade above 69 to as high as 70. So from 66.82, you had a great day trade, and then maybe you held a third, and there was no reason to maybe you got out of it here. I think I got out of it here, and then on this day when it kind of refreshed and said, hey, I could hold this, I was looking for a little momentum trade above 69, 69, 69, and there you go. And then this could have been, you're out right here when it went above and came back below. That was also a small red dog reversal sell, which we didn't get into. But that's really the tactic. The tactic is how do you take a descending trend line here and then find the pivot area where there's a fight between the bears and the bulls. The bears saying, hey, oil's going back lower. This is baloney. This was just an oversold bounce. And the bulls that said, hey, I think this is a viable pullback for another move here. And that's pretty much exactly what happened. And if you want to take a look at, the bigger picture of it, here it is. This was, remember this descending trend, this descending channel here, broke above. Remember, this was your commitment to this. Okay, came to 69. First time it goes to 69, usually you have some resistance. Came back, that was your red dog reversal. Here's when it took out the 8-21 day, and that was your move to some bigger resistance. And that was a heck of a nice little move in the XLE that, was hard to catch unless you really knew how to trade these type of tactics. Here, I remember when it broke above, it failed, had no commitment to it. So this was your commitment to it above the 8-21 day, which we talk about trying to be long. Here, you could have got out of the way waiting for a red dog reversal, and then pow. That's how you manage a trade, and that's how you do it with defined risk. The key here is defined risk, okay? So now, let's just have a tiny little bit of a quiz, just like you're in school, okay? I want you guys to look at the USO. Look at this chart and think to yourself, where is the red dog reversal? Okay, and by the way, I hate the USO. I think it's a horrible ETF. It doesn't correlate to oil, but, I have this here anyway. So think about it, close your eyes, write it down on a piece of paper, no cheating. You're only cheating yourself. Remember, never cheat yourself. Everybody knows, especially the guy upstairs. So anyway, where was it? Boom, there it was, okay? From 1150 down to here, went below 974, hit 956, came back above it. Nice day trade. If you took a third home, what'd you get? Nice follow through. So not only did you have a good day trade, you had a day plus trade. Okay, and then here, this actual pro gap held here, and then it continued before, coming back down. But anyway, all in all, this small tactic here gave you a nice day and, and a quarter trade. So let's get rid of these lines. Let's go to another chart. Oh, I like this one. This one was a lot of fun for me and for my community. We had options on before it cleared. Can you spot the red dog reversal? Take a look. Take a look where you could have seen a day or two pullback in order to get long for what wound up being a really nice move. So let's show you here. There it is. Boom. From 246 went all the way down about 9 points. Went below 237.89. Really went below by 30 cents, and I remember that too. So your risk was 30 cents, and then wound up giving you a great day trade, and it actually even took out a prior high, which showed some power. And if you took a third home, went right back to here. Okay, so all in all, nice day and a third trade. And if you end up holding the third, saying I'm going to give it to the low here because I'm a swing trader. Some guys don't trade every single day. They look for swing trades because they're a doctor, a lawyer, a policeman, a fireman, and they look for cash flow besides day trading for a living. That's why in my note I talk about if you have a swing long on versus you're very active. What I mean by very active means you're in front of the keyboard all day long and you get to massage prices. But anyway, from here, wound up giving you a trade all the way up to 250 and then took off to 270. But anyway, that's the tactic. If you're mechanical, goes below, comes back above, you're a buyer there. And then if you use a tier system, this could have been buy number 2 on the close. Said, hey, I'm taking a third. I don't want to give back what I made this day because this was an excellent day. You had some follow through. So because I could go to over 1,000 of these, and because I don't have 2 days like I do with my Redler Ultimate Access seminar, where I spend literally 4 days with everyone and go over 100 of these, I can only go over those for now. So what I'll do is I'm going to go over the red dog reversal sell parameters. It's just the opposite. Stock showing a positive trend up 2+ days in a row. You're thinking it went too far, too fast. You're trying to find a cute short to the downside. Usually what I say when I mean cute, everyone's like, red dog, what does cute mean? Is it pretty? Is it, is it handsome? Like, no, cute usually is a quickie trade that you do to catch a counter trend move against trend. You make more of your money literally when you're with the trend. But anyway, this could be 2 days. And what I say before, remember, you go up 1 day. This is day 1. In order to go up 2 days, you got to get above and stay above a prior high. So that's 2 days. Now, in order to get up 3 days, it's got to get above a prior day's high and stay above it. In order to go up 4 days, oh my goodness, get above a prior high. Then finally, in order to go up 5 days, it's got to get above. But what happens here? Now it went above and came back lower. And basically, that is your action area spot. So in order to be up 1 day, to go up 2 days, get above and stay above a prior high. In order to be up 3 days, get above the second day, stay above it. You'll go up 4 days. So that's why the prior high is very, very important. That is the action area between the longs and the shorts on who wins that daily battle. That's my little chalk talk. So anyway, let's go back to this. Let me get rid of that. So basically, trades above a prior high and then comes back below it. So then you could actually short it at that high and put a stop in at the day's high. And once the trade is triggered, you set your stop. You can walk away, go to the bathroom, go to the gym, get coffee, or you sit there and watch it. Sometimes it's better to step away and just put your stop in. You can make a lot more money that way versus counting the money as it happened. So if you have confidence in the setup, you can take home a third short, just like you can take home a third long. And typically the next day you get a little bit of follow through. The next day. So let's give a cool little example here. This is the IBB. Look at this here. Actually, this is a nice little pro gap. Just to give you tactics, pro gap above prior resistance. That's a good long, which gave you the reason why it went up 4 days. But that's a whole nother, little strategy. I just feel like throwing in there. Plus, it's above the magenta line. What's the magenta line? That's the 8 day. So this was a strong move. So if you were trying to look for a top, what does it have to do? It has to get above the prior high. And it could have been up, it was up 1, 2, 3, 4 days. Could it have been up for 5 days, 6 days, 7 days? Of course it could. That's why you don't try and, catch, pick a top. The same way you don't catch you don't try and catch a falling knife. So anyway, you go to this one, and the question is, what do you know? Which is something I always ask myself the next day. This is what I know. 327.54 is the high here. So this the close. The next day I'm writing my note. Look at the IBB. After its little red dog reversal here, it had a pro gap. Trend's been strong. It's up 1, 2, 3, 4, 5 days. If you're looking to sell it, or reduce your longs if it gets above and comes back below. If you're looking for a cute short against the trend, short it when it comes up and comes back below it, and then, see what happens next. So 327.54 is your major pivot. That is the battleground. To go up another day, it's got to get above and stay above to continue. Or if it gets above, squeezes the shorts, gets chasers in and comes back below. Otherwise, all of a sudden, I'm going to go, I just, chase this thing here, or, I just covered, I got to get short again. That's why it's such a great action area. So the following day, what happens? Ooh, looky. Went above, went to 329.90. Okay, went back below. So your short is here versus 329.90, and wound up having a really nice day trade, right? Wound up going all the way to the bottom end of the range. So I'm sure, anyone who was there probably took, a third short and said, hey, I'm going to give it to the high here. Okay, but anyway, if this wide range bar probably would have got me a little cautious, because all of a sudden, have you seen that on the last 4 bars? No. So right there again, here's your short, there's your stop. You made good money, take a third home. So let's see what happened the next day. I don't really remember. The next day, actually 2 days later, this one, if you stayed a third short versus that, okay. If you said, hey, didn't go down, I'm going to revisit. This time it went back above here. It's almost gave you a double red dog reversal. Went above here and failed. Little, squeezed the shorts above this, made a lower high here, right? Here's a lower high. It's almost like a little bit of a double top in the IBB. Kind of, draw like that, double top in the IBB, lower high. So this time you might have even got stopped out on your third, right? If you said, I'm going to keep a third, put a stop here, and then when it got above this high, you could have said, oh my goodness, I'm getting out. Went here, came back below it, then you reshorted it. So you lost on the third, but then you got back involved when it went back below with this is your stop, and look what happened here. Broke below this level here. So this is even a much more powerful day. Look at the size of this powerful day. This bar said get out of the IBBs and get out of Dodge. Double top here, 2 engulfing days. Anyway, that's a little bit more than you bargained for as far as tactics. Let's get rid of this. And then, if you stayed short, what happened next? Trended lower. Stayed at the bottom third of this range. If you were short here versus that, all of a sudden, came back. What did this do here? Kind of retested the 8 and 21 day. Did it get above it? I don't think so, if I remember correctly. So if you're still managing this trade from here, depending if you're micromanaging or you really think it's a short, ooh, look at that. Actually, this is a little red dog reversal here. So even if you got stopped out there, you could have said, hey, I just think it's rallying back to prior support that comes resistance. Small red dog reversal there. That would be, pushed through here, came back below it. You could have reshorted it there after making some nice money here. But, here was a little red dog reversal to cover. So actually, if I'm thinking about this now, this was one trade, and then you probably lost on the leftover third. Then you put it back on here. Then you probably added when it broke there, and then took home a third. This really gave you no pain if you were still short. Then you broke below this, stayed below it. Maybe here you're like, oh, look at that, down to 312 from 327. Now I'm gonna cover, or maybe you look for a cute long, right? Red dog reversal went below, pulled in, boom, that was your spot, and then here was your quick red dog reversal sell, and then boom. So those are just like my quick and dirty thoughts. When I'm on my private Twitter feed, I have a speed round at 3:30. I'm like, just throw names out and I'll give you my quick take on it. And I just, talk to you about what I'm seeing, how I see it. And the more you hear it, the more you'll be able to think about it the same way. But lots of things going on. Who's never seen this before, this might look like, Mandarin, but this is technical analysis, active trading with lots of different sectors wrapped into one. Here you're above the 8-day moving average trending. There's your first red dog reversal. Here's your second. Now you're below the 8-day moving average. Come back, red dog reversal, continuation to the downside. Wow, a lot of money to the short side, the same that was to the upside. Let's go into a little quiz. Okay, here we go. Can you spot the red dog reversal in X? Take a look, take a look, take a look. Right, what's the parameters usually? Here was actually a nice little breakout trade. What are you doing? You're above the 8-day moving average. Day 1, day 2, day 3, day 4. Where is it? Think, think, think. Right there, right? Pushed above, came back below. Now I'll show you the cute way. Oh, there it is. Boom. Broke above, 38.19, went to 39.14, so about less than $1 worth of risk. Came in 1 day, 2 days, 3 days, and then literally on this was a small red dog reversal the other way. That's your cover, and that's maybe even a cute little long if you were looking for, you know, a buyable dip, considering it was in a strong trend. But anyway, here's your sell technique if you were long, right? And then also potentially a cute short technique that wound up giving you a little bit more than a cute short. It actually was very pretty because it worked out to a little bit more. So here's another one. Can you spot the RDR sell here in the Qs? What does it have to do? It has to go up for what, 1, 2, 3 days, and 1, 2, 3 days, and went through a prior high. So you could have used that as a sell technique if you were long, right? This was an engulfing bar here. Actually, this is a little red dog reversal too. This was a sideways one where they probably stopped some people out and then reclaimed it and then broke above a 5-day range. So that was a good long. If you're looking for a sell technique, it went above here, okay, went back below. So I would reduce if I was long. And if you're looking for a short, you know, then that's your spot there, guys. And then there's, you know, went above, came back below. That's your mechanical definition there. Went above 146.21, came back below it. What is that, like 30 cents worth of risk? And you wound up getting, you know, a nice move below the prior low here into the moving averages. So cute short, that's what it was. And then wound up holding where it broke out from and kind of continued up. But anyway, that's how you could use this technique to sell if you're long, and also short if you're looking to short. I guess what I'm going to do is I'm going to continue to go. If Don, if you're on this, would you like me to answer some questions now, or continue and answer questions towards the end?
It's certainly up to you. I mean, some of them may bring you back to, you know, to certain points in the presentation. But I'm hands off on this, bud. I'm trying to answer the recording question. I'll answer it now one more time. The recording will be available on the TradeStation YouTube archive starting tomorrow afternoon, and also on the TradeStation video station if you're a TradeStation user. Scott, if you want to go back and answer questions about the red dog reversal, maybe that's a good time.
Okay, and you know what we're gonna do? I'm gonna keep going because I figure like I have good control of this PowerPoint, where if they take me back, I know exactly where everything is, considering I made this presentation. So I can get back there and then answer questions. And I think as we go through the presentation, some questions could be answered just by going through more charts and more setups. So at this point, what I'm going to go into is the H cell setup. So if you're a little tired, stand up, shake, you know, do 15 jumping jacks. Ready? 1, 2, 3, 4, 5, 6, 7, 8, 9. Okay. Get the blood flowing. All right. Do some push-ups. If you saw my last presentation, I actually had guys do a push-up contest, which was pretty funny. But anything to keep your blood going. So anyway, this is the H cell setup. To be honest, it looks more like this, which you'll know why in a little bit. It's not really a capital H, it's a lowercase h. So as traders, what we try and do is we try and name patterns that we could remember, because there's so many patterns, so many price points, so many pivots, so why make it hard on ourselves? So this is really your H cell setup. It's a way for, you know, a stock to decline, get a little bit of a bounce, starts to roll back over. You could short versus the top of this little H, and then add when it breaks a prior low. So you're getting one good short versus resistance, shorting a bounce, then adding when it breaks a prior low for momentum to the downside. So I like to just give you a little bit of my Are You Smarter Than a Fifth Grade drawing? But that's really the H, and that's a continuation of it. So let's get rid of this, and let's get into you know, the actual definition of it. So again, this is my #1 shorting strategy. If everyone who knows me knows that I'm not really a great short. I'm more of an active bull. I love when we're in portfolio approach. I love having 8 to 12 longs, using a tier system, looking for breakouts, finding the best stocks with relative strength. But, you know, markets go up and markets go down. So this shorting strategy helps me, especially when I'm in tactical mode. It helps me trade a stock that's in a downtrend, you know, in a way that's calculated, where you're not just pressing, but you're shorting a bounce. So helps enter shorts when stocks are in a corrective phase. Helps you short bounces, and then add to shorts when they break prior support, which I just showed you, which is the H. So here's your little bounce. There's your H, and it breaks this spot and continues down. I love this little pen. Okay, and then the strategy you need to know for downtrends. And yes, it's happened, right? Remember the financial crisis and the tech bubble bursting, and then we used to get 3% corrections and sometimes 5, 8, and 10% corrections. I know we haven't had it this year, but it does happen. You need to know how to short. I need to be able to do it too. Back in 2008, Mark Haynes called me Dr. Doom because I was the only one who said we weren't at a bottom yet. So, and then all of a sudden, 2013, people called me a perma bull, which is not true. It's just that was the trend. We were above the 21 day, we were above the 50, we were above the 200. But anyway, let's continue. That's the H cell setup strategy. All right. Again, this is just a reiteration of what we just told you, and now I'm going to give you kind of like an illustration on why you would use the H cell setup and what would give you a clue to look for it to manage a trade to the downside. So take a look at this this slide, and now we'll get into the chart. Okay, so look at this chart. This is Tesla. Okay, I remember this. This wasn't too long ago. This was last month. This is when Tesla was starting to act a little faulty. This is when Tesla broke its ascending little triangle here and got below the 8 and the 21-day moving average. So although I love being long Tesla when it's working, like I did, in my, it was actually my weather report. The first month was my stock of the year and went 100 points. But anyway, so this broke below the 8, 21, and 50. And when you're trading momentum names, write this down, you get tactical. When these high valuation momentum names break the 8 and 21 day, you get out of the way. Because what that does is it lets shorts basically recover and not be trapped. And then anyone who was trading the technicals get out of the way. So right here, when you had this first move below a prior low, okay, and then took out the 8 and 21 day, you needed to say to yourself, I need to be short. How do I be short? I use the H cell setup. Okay, so the H cell setup, which I'm going to get into, is really the micro version of this. So you go like this. This is your daily chart. And why would you think of shorting Tesla? But again, broke below the 821 the 50 day. That means it's no longer strong. Broke this little ascending channel here. That means you have to be careful. So that's just my thought process behind it. Okay. So anyway, you have another, all of a sudden, wide range bar that got rejected below the 8 and 21 days. So anyway, let's go into the more micro version of it. So just like I said before, here's your H cell setup. Okay, here was your wide range bar all the way to the low. All of a sudden from 332 down to 325, you needed to try and bounce, right? So right here, came in, tried to bounce up a little bit, got contained by the 8 and 21 day instead of being above it. So you might not even, short it here, but again, this is in the bottom third of this range. So you're saying, hey, I can maybe short here versus that. If you didn't, if you were just wanted a little confirmation. So here's your tier number 1, and then this is when it broke the bottom of the H. Tier number 2, and then it wound up going as low as 321. So here dropped fast. You waited for a bounce. You're shorting in the lower end of this H, and then you're adding when it breaks the prior day's low, because once it breaks a prior low, what does it have to do? It can get another down day. Then you even had another little, bear flag type of H cell set up, a little smaller one. So anyway, just to show you how you could have been, managing this trade, because look at the time on here. So this was the first opening move. Maybe you missed and said, hey, I'm going to short a bounce. Bounce happens into the moving average. You short here, add here, cover a little bit, comes back up, doesn't reclaim that spot. You short a little bit more, trades below this low, short a little bit more, and then you wound up going all the way down to 321. That's how you use this H cell setup in order to stay with the trade with the tier system as it trends lower. So it's your way to short a bounce instead of, because if you would have just pressed here, you might have got stopped out because you said, oh, it's not going to go. But if you short into resistance or verse resistance, you have a good price, and then when it finally breaks, you're adding to it and you're making cash flow. So that was a pretty nice scenario there for the H cell setup. So here you can continue. You'll see again back to the daily chart. That was the breakdown, and then if you want to do the micro version, it's the same way. So actually no, this is what it's showing, boom, boom, all the way down to, this was prior to earnings, which we don't take stocks into earnings anyway. But either way, Tesla was below the 8 and 21 day. You had lots of sell setups below this, and the way you do it is you short a bounce that doesn't take back a third, because that's the H, a third of this prior bar, because if it goes above half, all of a sudden it negates the power of that down move, and then it keeps continuing. And then finally, this one update probably got people out. And then that day was a fast and furious day to the downside, because fast moves usually happen from false moves. So let me show you another one in a different stock. This is, what is this? This is HRB, sell setup. Very similar, okay? Here, fails to reclaim the 50-day after getting back above the 8 and 21 day. And then now this spot broke, okay? So this spot breaking said, time to get short, right? Time to potentially look for more downside action. It's now, it bounced back into the 50-day, got rejected, little, insignificant bar, and then wound up breaking here. So now if you're looking to short it, you're looking to short potentially a bounce to then break this low, but you want to do it by using a plan. So with that being said, you could then take all these off and just see how here, this is the follow-through day. So you could have used the HL setup in this one and then the downside move, but if you zoom in, you'll see it happen the same way. Came in, all of a sudden, had a wide range bar, but what did it really do? It came right back into the bottom third. So this is your H. You might have said, hey, I'm going to wait, to see that there's not another bar here to take out the bottom end of this range. So on this bar, you can say, oh, look at that, it just got rejected. So maybe here you got short versus this high. So now you're short versus the high, and then you're adding once it breaks below, the morning low, because in order to go lower for another day, it's got to break below a morning low. So here was your shortable bounce, which is the bottom of the H, and then so you're in tier 1, tier 2, back to tier 1, because maybe you're holding some, and then you wind up having downside, and it hit as low as 2460. So by using shorting a bounce technique, you're able to get a good price, and then you're able to get a momentum price when it breaks the prior day low. And remember, like we said before, goes down one day, goes down 2 days, it's got to get below what? This. Go down another day, it's got to go below a prior low. So, you could, short the bounce into here, breaks this, continues, short the bounce into here, break more if it continues. And that's how you, actively trade it using tier system and cash flow, where it's not all or none. Okay, I do not like all or none. I never use all or none. Okay, you want to net money and you want to use a tier system. So here was the, wound up being that trade, if you step back, that's when it broke. Here was your first move lower, here was your next move lower, wound up going all the way down to here before getting a little red dog reversal. So anyway, this was a nice sell technique, and then all of a sudden it changed a little bit here. Look at that, a little red dog reversal to cover, and then you had a retracement, and who knows what happened here. This would probably be another spot to think about selling, as it could do this. I don't know what it did next, but I'm just thinking out loud. From 2650 down to here, you get some kind of tradable bounce or some kind of oversold bounce, but then if it gets rejected, you short versus this, then you add when it breaks that. But what you don't want to do is go back to the well too many times. So that's just food for thought. So before we get into the next thing, okay, what I like to do is I like to connect the dots. And a lot of people, okay, have been talking about Roku, right? Roku is an initial public offering. I don't even want to get into the charts yet. I just want to talk to you about initial public offerings, because I have 3 different strategies. One, don't look at the this thing. It's the art of the first day, meaning if you get above the first 5-minute high and stay above the first 5-minute high, it's potentially a buy, okay, to get a day 2. And then you get your post IPO high, which is your new pivot. Gets above a post IPO high, that then turns into what could be a potential swing trade. So so basically this is, art of the first day. I just want to give you a quick little tutorial, and this is a little extra bonus. All right, Roku opens up. I don't remember exactly where, it opened up. It could have just say it opened up. This is your first 5-minute bar. It hits 23, okay? And then, comes back down to 22. This is your first 5-minute bar. Now it's just say at 22, sorry for my, 0.5, okay? So many times people trade new issues, okay, and they lose money. Why do they lose money? Because it opens up at 23, then all of a sudden they buy it at 22, okay, or it opens up at 22.5, goes to 23, goes to 22, they're buying it, and then it goes to 21, then it goes to 20, then it goes to 19, and what does that mean? It means everyone who's in the deal, because maybe the deal was priced at 19, okay, so for them, they got a free lunch from 19 to 23. That's $4 worth of gains, and they're just flipping it because That's what they do. They flip IPOs. If you're in the syndicate group, or you're a sales trader, you get the free lunch, whatever it is. There are a lot of people making free money. So us as traders, you're not getting the free money. You have to work for it. So in order for this to be any good, what it has to do, it's got to show demand. So all these people that are on 19, they start selling it at 23, 19 selling it at 23, 19 selling at 23, comes into 22. All of a sudden goes sideways. Now it's a 22 half. And now everyone flipped out. So this becomes a very important pivot. So now if it gets above 23, that is your buy. Okay, because now it proved that you could make money in the aftermarket. Okay, so now it goes to just say, 24. And then typically, maybe now it goes to 25, or just say 26. And then what happens is it could go sideways all day for the afternoon, and then drifts down to 24. And then your next buy is when it gets above 26 later in the day. And a lot of IPOs do that. But in order for this to get to 27, it's got to get above 23. So you're not a buyer at 22. You're not a buyer at 21. You're a buyer when it gets above that 5 or 15-minute high to show that demand outstrips supply. That's a little bit of bonus for you guys. So anyway, now let's get rid of this, which is my gibberish. Write that down. I want to put together a lot of my strategies using Roku as an example. So this is Roku. This was your first day. Okay, there was a decent trade there in the first part of the day. Oh, actually right here. Okay. And all of a sudden, the second day, what did it do? Gapped up, traded below the low here. It's done. You are away from this stock. It is now done. You had a day and a half move. Congratulations. And then what did it do? Went sideways for 6 weeks. And then what did you have here? An earnings gap. What do we call that? A pro gap. A pro gap is powerful. If it doesn't get filled, usually you continue in the same direction as the pro gap. Oh, and what did it do? It took back all the moving averages. Then what's your next buy? When it takes out the post IPO high, because what happens? There's nothing to the left. Sky's the limit. There's nothing there. There's nothing to base trades off of. So what'd you have? Day 1, day 2, day 3. Everyone in the news was saying, I didn't trade this, guys. I did not trade Roku on this scenario. I was watching it. Then all of a sudden I have 800 associated members of my BD, and a bunch of them were caught short. And it was day 3. And I'm like, ooh, now this is getting a little interesting. So I walked over to my trade support. I said, how much does it cost to borrow? Whatever it was, $48 per thousand. And I said, what do I know? I know this. I know what the high is. Maybe we get a red dog reversal. Stock was just below 24, just took out the post-IPO high, gave you a nice follow through if you long, gave you what happens for a day 3 to happen. What has to happen? It's got to get above day 2. That's why this high was important. Did it go through and fell? No, it went and continued. So this is your important pivot if you're looking to get out of your long, or maybe look for a cute short. So that pivot for Roku was here. Boom, 47.49 from below 30. Big move. Could have went to 70. In order to go to 70, what does that to do? Get above 47.49, stay above it, and continue to squeeze. But what happens here if it gets above and doesn't continue? You get yourself a red dog reversal. So what did I do? I have a note that I write every day from 6:30 in the morning till about 8. And in the note, I said to my guys, I said, hey guys, this is, I think, right from it. Oh, let's go back for a second. I said, just be careful, because it's come a long way. If you're looking to be short, use the red dog reversal, or I think it opened up $2 that day. It can go from green to red, which would be a reversal strategy. So just like all the other red dog reversal highs, this wound up happening the day after. Traded above 47.49, went to 48.40. Look at that right there, 48.40 to 47.49 to 48.80. Not a heck of a of a move through the highs here. So once it went through the high, came back below, you could have shorted Versat, walked away, went to the gym, you could have went for a bagel, you could have got an egg white omelet, and boom, look at the size of the move down, which still was only about a third of this. So that's how you catch a cute short that could turn into something a little bit more. But you need a plan for that, and that's why I have my note. Okay, so this was what was in my note, right from my note and right from my private Twitter. What I told readers before the collapse from my morning note. Roku had a huge move after earnings. It hit 47.49, and it's up again today. I would not chase it. So right away there, everyone on TV was talking about how crazy the stock is, how it can go to 100, 150. I would not chase it. Perhaps today is the day it goes from green to red. So short it versus a 5, 15, 30-minute high, because that's what your risk is. Or maybe it does a red dog reversal where it comes below, pushes above, and you either, if you're long, be careful, or you're looking for a short, be short. This was on my private Twitter feed. If you're not long Roku, today isn't the day to start up here. Okay, so now let's go even one more step before we get into questions. So again, here was the entire strategy where pro gap, took out post IPO high, went up here. Here's your pivot for a red dog reversal. But now let's use the H sell setup in order to manage the short to the downside, because you learn that. Okay, how do you stay with it, and how do you book money and continue to basically manage it? So if you go to this chart, here's your red dog reversal, traded above the prior high. Okay, 48.80. Here it tried to go again. I remember this kind of hurt me a little bit. I was like, oh my God, I covered a little bit, but then once this happened, I said, now I'm going to reshort it again versus the prior high. So sometimes you have to try it a few times, especially with this one. And then I was thinking, if it gets below this and this, I'm going to add to it, right? This is your 15-minute chart. This was your quick short squeeze, and then all of a sudden started to get a little bit weaker. So now you're getting really juicy. I'm like, oh my God, I'm short tier one. Let's see if this breaks, because it's just tripled or whatever it did. And then here, it broke this spot. So you could have been short versus that, or short when it did the red dog reversal. And congratulations if you did that. Then it broke this one spot to fill the gap, and then went below this trend line and gave you your H sell setup. You could have covered a little bit here, saying, wow, I just made some good money from 46 or 45, or from the red dog reversal price of 47.49. Cover some, and then what did it do? It came back up, retested the trend line. You could have shorted here, short a bounce, and then when it took out this low here, added to it. So short one, short two, and then went all the way down to 38. And then what you could have done, if you said, hey, this thing came from below 30, I made really good money shorting it on the red dog reversal, or adding here or adding here, I'm going to hold the third, because I should get a little follow through, right? People might be a little scared that could be a top. And then all of a sudden, the next day, it wound up, it was today, it opened down to 35, $2 a follow through. I actually made a little bit of money buying it this morning from down 2 to up 2. Just for a quickie, considering it was just at 48. So that's how you could use all these strategies to get short, to get long, to use a tier system with the H sell setup, and put it all together. There are so many of these that happen every single day if you look for the setup versus look for a bottom, look for a top, or listening to the TVs. I come in every day in the morning. I'm in my office at 6:30 writing my note, and I literally put my music on and I turn the TVs off. I don't want to listen to everyone talk about the market crash or about Washington or about the president. I want to look at stocks and I look at charts. And these two setups, the red dog reversal, can help you find the bottom for a day trade on for follow through on a major trend, and the H sell setup can help you short bounces and basically do it with a plan versus just without a roadmap. And as we talk about roadmaps, what I have my specialty in is that I put together my routine and my game plan. Every morning I'm up at 4:45. I'm starting to tweet on my private Twitter. Then I start writing my note. It takes me from 6:30 till 7, from I would say about almost 7:45 until I send it to editing, and it gets emailed to you at 8:30. That goes over 20 to 25 different types of setups and strategies. That includes the red dog reversal. It has the H sell setup. This morning, if you look on the public Twitter feed, I put like 10 charts on there because I felt like people needed help today, and I want to show you what everyone gets. And so there's lots of different ways to do it. And if you're not using your resources and you want to have me help you with your morning game plan, okay, which is what I do every day for my own trading, that I've developed a system over 18 years. I'm hoping to do it for another 18 years, is by writing my game plan on paper, which is called Redler All Access, and it's my morning note. My morning note gets delivered every day by 8:30. You also have a video every morning. Okay, it gets, I think, on demand at 8:15. Going over my thoughts for about 10 minutes, going over the charts that I have there. So not only do you get the morning note, you get a video. Some people like to read, some people like to watch, some people need to do both. And you also get a private Twitter feed, that kind of updates you during the day. You get a recap at the end of the day, and literally you're getting a heck of a lot in order to get yourself planned. I'm going to put in here an actual link to, let's see, hold on a second. Oh, you know what? Sorry, I didn't even see all those questions there because I didn't have it up. So at this point in the chat, my editor, Michael, is going to give you guys a very, very, very low cost, great deal. He's going to give you 30 days of my note. That includes my morning call. That includes my video on my private Twitter feed, I think just for $7. So for $7, you could try my morning product, which again is written by me. It's not written by my staff. It's 20 years of my experience rolled up into one. It's how I approach today, what I'm looking at to make active cash flow with. You get to see my positions. The bottom of the note has all my disclosures. You get to see what my focus is. I do all the sectors as far as levels on them, and then I have about 20 stocks that are typically the fastest moving stocks that I give you guys a plan for, whether it's an active trade, a swing trade, what the composure is, and it's done real time. It's done in the morning, not the night before. A lot of notes are written the night before when everything changes in the morning. I take everything into account. I look at the futures, what's happening overnight. I read all the upgrades, downgrades, and comments, and then I put together all that within my technical charts, and I put it all on a piece of paper, delivered to you with the video. That's my only thing I'm going to say as far as my selling for you and for this. So at this particular point, it's 5:34. I'll answer some questions. We've already gone over an hour. It's supposed to be 45 minutes, but it's fine. My wife could keep dinner on hold. I would definitely want to answer some questions. I don't know if you want to moderate it, Don, and because you've seen them all come through. I haven't seen them come in through. I've been just doing my presentation, and I could answer them, one by one as you, get it done. The note gets delivered at 8:30 in the morning. I start posting tweets around 4:45, and then I put about 10 charts on my Twitter feed between 8:30 and 9. How do I define a pro gap? A pro gap is a huge gap up, usually with a binary event like earnings that gets defended, or some kind of FDA study, and then it holds above it, digests above it, and goes. I have a ton of strategies. Basically the Red Dog reversal is just something that people kind of know me by, so I try and teach you, and it's something that you could do it anywhere. Every day on my Twitter feed, people are like, oh, did you see the Red Dog reversal here? Did you see the Red Dog reversal there? And I'm like, good for you. I'm glad you learned how to fish, because I'm not always going to throw the fish in your boat. I want you to learn the tactic. You do it. And then if I'm looking at the same one as you, maybe you do a few extra tiers and you make more money, or it gives you more conviction to do it and stay with it. So my job by putting together my morning note and my morning game plan is to help give you more conviction in your morning game plan. Because if you have 5 things you're looking at, and if I'm keying on 2 of them, maybe you'll say, hey, if Red Dog's looking at these 2 and I'm looking at them, maybe I'll add a little bit more size, or I'll make sure I do that trade. So it's I'm here to help you get more conviction in your own process, not do it for you. Yes, you could apply the system to futures also. It's just a little bit different. It's all night long. I don't trade futures because, again, I'm up at 4:45 in the morning. I usually leave here at 6, and I have a family at home, and if I was trading futures all night, I would never sleep and I would burn myself out. So it's part of my process and my system that I don't trade futures, because there's more than enough going on, intraday that I could make money with, and I don't want to burn out. When I click on this link, this is the message I receive. Is everyone clicking on the same link, and that they can't get involved, or they can't get the special deal? This Red Dog, what is your opinion of crude? It held 55. From 57 and change, I think it has to hold 54. Otherwise, it's in a little bit more trouble. I figured, from 51 to 57, it would pull back, and this is probably where it has to hold. The Red Dog reversal, Javier, could be, the perfect entry, meaning, where as soon as it gets above the prior low, you buy it, and then you put a low in at the day's low. Or some people like to see the day's low, buy it a little bit, burst the low, because sometimes there's a bigger range before the prior low, so they want to get in a little early and then add to it when it does the Red Dog reversal. Yeah, sometimes I get chopped up too. Sometimes you could try a Red Dog reversal at 10:30, Clint, and lose a little bit because it comes above and then fails and then makes a new low, and then all of a sudden the real low happens at 12:30 when you get bigger reversals. So you have to make sure you stay with it. There are many times I'll try the Red Dog reversal at 9:45 and lose a little. I'll try it again at 10:30, lose a little. Then all of a sudden the major reversal happens at 12:30, and A, I might be at the gym at a spin class because I've up since 4:45 and miss it, or B, you got to make sure you go back to it, because when it really triggers, you have to make back all the little paper cuts you had, and then have enough on for the real trade to trigger. So sometimes it does happen where it doesn't work the first time it gets there. That's why it's a really bit of a rubber match spot. I see it right here, Jacob. Where are the here? No. It could be, if it's done near a moving average, it gives you a little bit more conviction to do it. Like the red dog reversal happened a day or two ago in JP Morgan right at the 50-day. It happened with the IWM at the 50-day. So if you all of a sudden see 2-3 down days and then the 50 days below, sometimes you could buy it at the 50-day, it comes off the 50-day, and then you could buy more when it reclaims the prior day low. So now you have two buys, and then it goes green, you sell some, and all of a sudden that's a great day. When you do get a red dog reversal that combines with a key moving average or a key level, that's when you have to swing the bat a lot harder. Sometimes red dog reversals are just real cute little cash flow trades where you hit a little single or you make a little bit of money, but sometimes they're huge inflection points where you swing for a double or a triple. How did you pick those moving averages and do, you know what, the 8 and 21 day is just something that I've always used. You could use the 9 and 20, you could use the 10 and 20, you could use, it's just really a zone. But the way the market is right now with high frequency trading, it's not a perfect science. It's really just what trend do you trade? Are you active, and do you try and trade for a living where you want to, be in a portfolio approach when the market's moving fast above the 8 and 21 day acting strong, or are you not as involved and you want to be in some good stocks, and as long as they hold the 50 day or the 200 day, you're not going to massage them and you're just going to let them go for you and make some cash flow around your other job. So for me, I trade real time, I trade for a living, and I only want to be in things that are special, and if they're going to be special, that means they're ready to move, they're ready to trade with patterns, and they're typically above the 8 and 21 day. That means they're trending strong. If they're below them, you know what, they're probably choppier, they don't trade well, and they don't deserve to be in your portfolio approach. Well, it depends on your buying power. Depends on what you're willing to lose. I definitely use the VWAP. VWAP's very important, Jacob. A lot of intraday moves are based on it, because the sales traders these days are no longer executing their own orders. They get an order to buy 200,000 Apple for the day. They'll say, hey, put it into a computer to get the VWAP. So sometimes you want to make sure you're not buying if it's too extended from the VWAP, and you're not shorting if it's too much below the VWAP, because computers at some point tend to always get it to the VWAP. So, that's something different. I would say 2 years ago, I never used the VWAP, and now it's a tool that everyone uses because of all the computer and passive investing. It's hard, you're just not getting things so extended from it. Sometimes it's extended from it for a week, but it typically works its way back to the VWAP. So you definitely need to know what's going on there. Mark, with Roku here at 39.30, I think there's a little bit, this morning was the play from down to flat to, and then when it took back yesterday's low and pushed up, I would be in small. I think it's a noisy area. If you look like a rubber band, it was stretched to the upside, so it was a good short. This morning from 48 down to 35 was a little stretched, and had a huge travel range here at 39.30. It's not as compelling of a trade. If I had to do something overnight with it, I'd probably be long a little bit versus short a little bit. But then if it got to 42 to 44, we'll see, if it makes like a lower high and starts to wedge. I do think red dog reversal is better in the AM. I would say 10:30 is probably the best time for it to happen, because by 11:30 or 12:30 you're too worn out. But doesn't mean it doesn't happen then. Rarely do I see a red dog reversal at 1:30 unless it's a major market red dog reversal. I've seen a lot of times where market will be down for 3 days in a row. Everyone will wish for a down open, and the market will open up 6 handles and grind people, and then all of a sudden, midday, all of a sudden you'll see a sell program break it below the 4th day low, stop people out, and then reclaim it at 130, reverse it, and that could be the end of it. So I would say market major reversals sometimes happen 12:30, 1:30, but stock red dog reversals to me usually happen on the buy side around, anywhere between 10:30 and 11, or that's when I hope they happen. And sometimes the other red dog reversals, topside red dog reversals, happen in the afternoon, or sometimes at 10 o'clock in the morning. Yeah, they can happen at any time, to be honest. I quantify my targets based on the chart, based on the type of sector it's in. There's different targets for energy names versus a name like Amazon. You have to look at the range and look where you see resistance 1, 2, and 3. Sometimes I'll say I'm looking for a red dog reversal, but I'm just looking for a cute bounce, meaning like what's the easy bounce? Where would it hit resistance and maybe fail? Or what's resistance to where it gets past the easy bounce, but then a spot where like the sellers have to make a stand to reject price in order for them to still be in control. So to me, I'm always talking about control. Who's in control? The buyers or the sellers? And if you're trying to think about who's in control, also what time frame is it on? Is it active control or is it intermediate or macro control? And that's why I use the moving averages. When you're above the 8 and 21 day, the active investors and traders are in control. When you're below the 8 and 21 day, doesn't mean we're in a correction phase. It doesn't mean we're in a bear market. It just means that, hey, market slowed down. You have to be a little bit more careful and a little bit more selective, that it's not going up as fast and furious where shorts are trapped and you have to be on your toes to buy quicker. Questions? I always look at the SPY. I trade with relative strength, Matt. So, if I have a swing account and an active account and I have 6 level 2s open on each screen, I always have the spiders there because I'm always looking to see, hey, in the morning, did the SPYs and the S&P just continue lower, and did my stock hold up? And if my stock didn't go lower and the S&P futures or the spiders just dropped 60 cents, I'm looking to be buying that stock that didn't drop as soon as the S&Ps bounce. So I'm typically always watching the S&P in the first half an hour to see where the relative strength is or where the relative weakness is. Because just say 935, the spiders rally 80 cents and my stock didn't move, kind of like yesterday with Apple. I was like, oh, Apple's really weak. And then Apple wound up rolling over in the afternoon and making lows. Then, today too, Apple is a little weaker. But I'm always watching the S&P versus stocks, and I'm looking at to see if there's relative strength, relative weakness to base my decisions on. And then I overlay pivots, prior day's lows, highs, and chart patterns, which is how I come up with my morning game plan. You know what? The reason why I wouldn't, Clint, on this is just because it's like a triple bottom. 256.52, it's bounced off so many times. I was more looking for it to break below it, and give me a move towards 254, because how many times could you keep knocking on that door, So to me, I was looking more for a red dog reversal in the banks today, which is what happened. If you look at the banks, look at JP Morgan. JP Morgan was an unbelievable example of a red dog reversal. Not only did it come into prior support of 95.5 to 96, then it reclaimed 96.5, and then it was the first one to go green. So JP Morgan was a bread and butter trade today, whereas Citigroup didn't act as well. Either did Goldman, and Bank of America did it pretty good. You guys, have you guys had success clicking on the link to the special deal? I'm telling you, $7 to basically get Redler All Access in full capacity for a month. If you don't do it, then I guess you I don't know, you don't value what I say. So at this point, if you sign up tomorrow morning, you'll have a note in your inbox by 8:30. You'll have access to my private Twitter that starts usually at 4:45, and it's typically in full force Monday through Thursday. Then on Friday we have a Short Hills office, so I trade out of Short Hills, so the note tends to be a little bit less, and so does my interaction with the market. But from Monday to Thursday, it's pretty robust. Matt, I do use Fibonacci's depending on the type of market we're in. I don't usually use them for extensions. I usually use them to measure a bounce, because if a stock drops a lot, if it bounces back more than 0.38%, then the potency of the fall isn't as in power as if it gets contained there. If it gets contained at 0.38, you know what? Then it's really weak. It usually rolls down. You get your H cell set up, and boom, you're done. If it bounces back 50% of the down move, all of a sudden it negates the power of the down move. But sometimes also you get a 3 or 4 day, big market move. What I'll measure is, a retracement. Like, so just say a stock goes $15, I'll measure to see how much it retraces to see how strong it is. So a stock goes from 30 to 45. If it retraces only 0.25% of that move, it's strong. It's going to create a bull flag. You have to be there. You have to buy in the flag add when it gets above that pivot high. Or if it all of a sudden it comes in more than 0.25, 0.38 is still strong. But then once it pulls in 50% of what that initial move, it starts to lose some of its power. So I do use Fibonacci levels depending on where we are in the market and what we're looking at. Well, Kathy, what you might want to do is you might want to watch it a few times, because if you want to read the slides, I'm talking. Listen, I did a course 2 weeks ago in Times Square where I did a PowerPoint literally from 8 in the morning till 5 o'clock at night on Saturday, and did the same thing on Sunday. So it was granular. It was nuts and bolts for beginners, intermediate, advanced guys. Here I had an hour to go through lots of different concepts. So maybe I did you guys an injustice, because I didn't just stick to the red dog reversal and the H cell setup. I tried to talk to you guys about moving averages, about downtrends, about a tier system, about how to stay with trades and how to be a swing. So it might be a little bit over your head. What you should do is, Don, I'm sure will provide the video so you could watch it back, watch it 5 times. You might get something out of it every single time you watch it, and then also read the slides, because the slides are very textbooky. I kind of used the slides, and I also created my own little conversation around it. I give you guys pivots, and I give you thoughts, and sometimes I'll tell you I'm going to buy it here, or sometimes I'm going to say the easy bounce is to there. I rarely say buy this here, sell this there. This is not what's it? Tell me. It's a little bit of both. But what you're doing with my note and with my videos is you're trying to learn how I think and why I'm thinking a certain way. And then what you're also doing is then you're taking my game plan and then you're combining it with your own. And if they combine, it gives you conviction to put on your trades. I will say at the bottom of my note, after doing all the technicals, I'll say my focus. Like today, my focus is is to buy the banks in this area and if they reclaim yesterday's lows. And and then I wrote where resistance was. I said the same thing for the small caps and BABA. BABA, I lifted the chart. I didn't say I'm buying it here at 178. You could look at my Twitter feed. I drew a circle around the 50-day, say I'm going to look at it here for a buy signal. It went actually $1 below, but then reclaimed 178 and then closed at 181. If you're on my VTF, you get to see my trades live. If you're a member of Redler All Access, you get to see the note and the strategy. And sometimes in the private Twitter feed, I'll post a glimpse of the VTF so you could see what I'm in at like 9:41, what I'm in at 10:15. I'm not always telling you exactly when I'm buying and when I'm selling, because sometimes I'm feeling it out where it doesn't quite trigger, but then it triggers and then I'm busy and I don't talk about when, how it triggered, but I give you the strategy prior. So every now and then you'll get the strategy and I'll tell you when I'm doing it. Sometimes you're just going to have to know why I'm doing it and do it on your own. And that's how you're going to make more money in the future, not by being told what to do, by learning why I'm doing something and then you being able to do it on your own. Okay, I'm there also to hold your hand and give you confidence, but I'm not, there to force feed you. Not really to exit long, it's more to figure out what to be long. So I'll use my fib if a stock has a big move and it starts to retrace. I'll put my Fibonacci retracements in there to see how strong it is so I know how quick the next move is going to come. And if the fibs don't hold, then it tells me that it went too far too fast and it takes other time. I only use those at extremes. I call myself a cotton napkin technician. I use moving averages, chart patterns, trend lines. I don't use so many different analytics because in my opinion, one analytic negates another analytic that wants confirmation from another analytic, and then all of a sudden you're not pushing any keys because you're overthinking everything. For 20 years I've developed a feel, so I put my feel with tactics that I put on paper and I just execute. And that's in the first 3, 6, 9 months of trading, you're not going to have a feel of the market. The way you develop the feel of the market is by watching the market for multiple years, by keeping a journal. What you should do is keep a journal every single day, meaning put together what you had on your game plan, and if you if you did 2 things versus 5 things, and the 3 things that you didn't do work, you write down and say, hey, why didn't I choose these stocks and why did I choose that stock? Or if you bought a stock and it was working, you just sold it and it went a lot higher, you look at it and say, why did I sell that? It didn't do anything wrong. It kept making higher highs, higher lows, and then you might say, oh well, I wanted to make the money. Then write down next time in your journal, say next time do the right trade, don't count the dollars. And the more times you write that, next time you're looking to sell it because you're up money, you'll say, hey, is this still working well? should I still be in it? And then you'll do the right trade. And that's how you develop your inner voice, by writing things down in a journal. Do you have any more questions? I'm really giving you guys like a lot of information, and I apologize if I'm talking over your head as far as things pretty fast. Years and years experience. You don't want to trade like me. You want to trade like you. I do. The Modern Trader, if you want to look up, is a book that I wrote. It's more of like a storybook with what it took for me to get to where I am today, with stories of all the partners. But I would say How to Make Money in Stocks. I like that book by Willie O'Neill. Hold on. I love, I'm an advocate of IBD. I think IBD is a great newspaper. Oh, wait, hold on, let me see something. Oh, here we go. By the way, that's my private Twitter right there. Red Dog, no, this is at Red Dog T3 is my public Twitter. My private is Redler All Access. Nope. It could be one big one. It could be two. It could be three. It could be four. Sometimes it just goes sideways. Yeah, IBD. I love IBD. Best newspaper in my opinion. And that's who the major publisher of IBD, his name is William O'Neill. He's the one who wrote the book, How to Make Money in Stocks. I've learned a lot from him. I've actually taken his seminar about 10 years ago. Oh, thank you. That's what gets me up at 4:45 in the morning. That's great. There's a lot of ways to make money in this market. Everyone can do it. I feel like I'm not giving away a secret sauce. I'm just trying to give you guys some tactics that I use, and you have to create your own process. I talk about a routine. In any business you're in, you have to make a routine. You have to love your routine because you do it every day. If you don't like your routine every day, you can't do it. You're going to burn out. So my biggest, suggestion for you guys is develop a routine that you like and you love, that has balance and a system and a process, and keep working on it and keep evolving it. I've evolved my process 10 different times, and I change with the market because the market's always going to change. And the market's going to be here in 5 years, 10 years, 20 years, 100 years. The question is, are you going to be participating with it? So you always have to evolve, and the only way you're going to see things clearly is by having mental toughness and mental stability. And the only way you're going to have mental toughness and mental stability is you learn how if you have a bad day in the market, it doesn't make you a bad person. Okay, you have to burn it off, and you have to readjust and learn from your mistakes and work on your strengths and keep doing it, and you can make a career doing this. I've been doing it for 18, 20 years. I've watched thousands of traders do it and make a living at it. Sometimes it's hard, but I'll tell you, if you leave trading and you go try and make a living somewhere else, it's a lot harder. I've seen that happen too.
Well, Scott, this is Don Prattle again from TradeStation. I want to thank you so much for all the time you spent with us and our traders today. We really do appreciate it. You've done an excellent job of discussing your strategy and going way past just your strategy into your trader psychology, your need for trading routine and discipline. I mean, I think everybody benefited here. I want to really do thank you for your time. To everybody that attended today, I've posted in the chat panel a number of times that you'll be able to see this video sometime tomorrow on the TradeStation YouTube archive site. If you're a TradeStation user or a TradeStation customer, this video will be in the video archive, or the TradeStation video station archive, and you'll be able to see that tomorrow as well. So we know that Scott has a lot to talk about, and so we'll be happy to schedule him again in the very near future, certainly during the first quarter, as we run through our get ready for the 2018 trade. So to Scott and your team, thank you so much for all of your preparation for the presentation and for sticking with us for actually an hour and a half almost. So let's have a great night, and we'll be back. There's always another trading day, right? We'll be back tomorrow. Take advantage of the offer that Scott's placed in the video, and contact his team at T3. So. And also, Paul Gaynor at TradeStation can't answer your questions about the TradeStation platform. He's available at the number on the screen, 803-3847. That's area code 312-803-3847. So to everybody, let's have a great night. Let's go get some dinner and be ready to hit them tomorrow.
Again, thanks for having me, and no, I'll definitely be back. I love working with TradeStation. You guys are a quality organization. You care about your members, and I just like being involved with people who try and better themselves and make the effort. And if you're here at 5:59 at night, sitting on a webinar learning tactics, you're trying to better your life, which will in turn make you more money, and in turn, just have positive things happen. Over the weekend, I always put out some tweets just mentally, like a negative mind creates a negative life, all those kind of things. And one other thing I want you guys to write down and maybe watch, okay? Google Why We Fall. All right, it's a great video. I post it all the time. It's 6 minutes. I talk about feeding the brain to make mental toughness. That's a video that helps create the mental toughness to then have you execute on your tactics and your X's and O's. So it's all one big formula. So work on it and keep evolving it, and I'll see you guys soon. Thanks for having me, guys.
All right.